Okay, so moving averages, what actually are they? Now, a moving average is a stock indicator that is commonly used in technical analysis. It can help filter out the volatility from random price spikes to give a really smooth average of the price over a specified period of time. Now, it's based off past prices, so it's what's known as a lagging indicator. And this means it won't produce signals as such, but actually confirmations. And what I mean by that is they are used to identify a trend in the market or confirm a reversal in the market. And to put it simply, if you see the price above the moving average, then price is bullish, i.e. the price is moving up. If you see the price below the moving average, then the market is bearish or the price is going down. And if we have a crossover, then this can imply a trend reversal. So, what are the three types of moving average? First of all, we have the simple moving average. Now, this means all prices within a specified time period carry the same weighting. And what I mean by this is, say you had a 20-day simple moving average, the way it's calculated is just the price on each day divided by those 20. So each time a new candle forms, the oldest one, so in this case the 21st candle, is dropped from the calculation and the newest one is used. This moving average is typically slower to respond to spikes in the price, so you can see other types which can actually counter this. So the other types we have weighted and exponential moving average. Now, the most important information to take away here, because I don't want to overcomplicate it too much, is although they are calculated differently, they both put more weight on more recent time periods and less on older time periods. And as a result, this means that it can respond quicker to those really rapid price changes. And you may be thinking, okay, which one do I use? So which one do you use? Well, it depends on what it is really you're looking for. Think about what trader you are or what trader you want to be. And with that in mind, use the exponential moving average if you are on a shorter time frame, say from 1 minute to 1 hour. Also, if you're on a fast moving market with lots of random price spikes, and the most obvious one I can think of is gold. Use the simple moving average if you're on a higher time frame, something like the 4 hours and above. And if you want to hold swing trades, such as trades that you're going to be holding for at least maybe a few weeks. So that's the theory done. So let's dive right onto the chart to see how we can actually trade moving averages on a live market. Okay, so I'm on the chart now and I'm going to show you simply first how you can use these moving averages to show the general direction of the market. So I'm adding on the simple 50-day moving average. If you don't have your moving averages on the chart already, just click indicators, moving average, and then you can double click and actually change your time frame that you like. I've already got my preferred ones on there, so I've just added on the 50-day moving average for now. And as you can see, that since we had this cross in May, we've been trending to the upside. I think we can all see that price is moving to the upside from this level. But when I add on the 100-day moving average, yes, the story is the same. We're still trending on the upside, but the curve is actually a lot flatter. And the reason for this is because longer time periods react to price changes more slowly, but more importantly, they are more reliable. And what I mean by this, you can see that the 100-day moving average price is actually respecting the levels a lot cleaner. Look at that one there, which is really clean. And most recently here, compared to the 50-day moving average, where we see price chopping and changing in between. Quite confusing signals here. Now, what some traders would have done is use these levels on the higher one, like the 100-day moving average, as a support level to buy, which would have been a nice buying opportunity. But there is a much better way of trading moving averages, which I'm going to show you now. And this would be when a series of moving averages actually crosses over. Now, I like to use the 50-day moving average, the 100 and the 200. And this is because I've tested these levels and I like these levels the most. Now, let's take a look at this gold buy from the beginning of the month. So I'm going to replay the chart all the way back to here. And you can see that at this time, from the beginning of the year, really, of 2021, you can see that price was trending to the downside and these moving average lines were acting as resistance levels. But we created this double bottom here. Price started to tick to the upside and you can see these moving averages now have started to move towards each other. Now, when a smaller time period movement, this is really important, when a smaller time period moving average crosses over and above a longer time period moving average. So in this case, the 50-day moving average, which is this purple line, crossing over and above the 200 and the 100-day moving average, that can be seen as an indication to buy and that trend is shifting to the upside. Alternatively, a smaller time period moving average could cross over and below a longer time period moving average, which would be an indication to sell the market and that the trend is shifting to the downside. So let's see what happens here. If I just play through the chart, you can actually see now we've had this 50-day moving average coming through, crossing over and above the 100 and the 200-day moving average, which is a really nice indication to buy the market. So what you could have done is bought the market from that daily close. Your stop loss is just below the low, and we could have aimed all the way for potentially the February 2021 highs, or even maybe again a bit higher and aim for this high here, but maybe taking profits along the way. So you can see that we've now been tagged in to this trade, and if I play the chart through, you can see we had this nice expansion. The moving averages are now ticking firmly to the upside. A bit of a pause in the market, a bit of sideways movement, and you can see this lovely expansion to the upside and actually run up and hit our take profit and a bit more. So you can see how we can use these crosses to buy or sell the market, and really it's the same story. If you go all the way back, further back through time, you'll see it constantly. You see that we're here, prices trending to the upside from November all the way up to January. We had this moving average now start to tip to the downside, and the 50-day moving averages crosses over and below the 100 and the 200-day moving average. And when this happens, price level, we could have sold the market around here, and you can see that price run all the way down, and depending where you had your take profits, but still a really nice trade. And if you go back, you see again another example, 50-day moving average crossing over and above the 100 and the 200-day moving average, indication to buy around here. And as you can see, price actually went up and tested the November 2020 highs. So that's the way that I like to use the moving averages to trade. I hope everyone has enjoyed this video and learned something from it today. Please like and subscribe to this channel. It really helps support our channel. We'll be putting out more of these evergreen videos as well, more of this educational material for you. Thank you very much, guys. Thanks for listening, and I'll catch you all for the next video.